Welcome to your commercial-free, uninterrupted investment show, sponsored by the SEC-registered investment firm, Wilsey Asset Management, a fiduciary firm owned and operated by President Brett Wilsey, who has been putting clients' investment needs first for over 40 years. The Smart Investing Show has been giving unbiased financial information for over 27 years on local radio stations right here in San Diego, providing you with fundamental analysis on stocks and investments you want to know about. Now, here are your hosts, Brent and Chase Wilsey.
Well, good morning and welcome to the Smart Investing Show. I'm Brent Wilsey, just about 8 o'clock on a Saturday morning. Great to have you here this morning. And with me is Chase. Good morning, Chase. How are you doing this morning?
Hey, good morning. Doing well.
We got a lot to cover today, so let's get right into it. Let's get right into it. But before I get into it, I want to talk about the workshop coming up because it's this Thursday. We're sitting here talking like, really? Is it this Thursday already? But it is this Thursday. It is going to be Thursday, April 7th at 6 to 8 o'clock at our office here in Scripps Ranch. And at that workshop, you're going to learn all the important things, such as what is true financial planning, what is that individualized concentrated value portfolio that I've used for many, many years, that I've designed that works very, very well, tested through all the hard times that we've been through, how to find good quality business at a good price, and why investing in strong equities can give you the best long-term return if done properly. Nice thing, it's no cost for it. We do it for free for you. But what you have to do is sign up for it. Go to our website, smartinvesting2000.com. That's smartinvesting2000.com. Or you can call the office, 858-546-4306. That's 858-546-4306. Love to see you there. Be great to see you there.
Yeah, looking forward to it.
Yeah.
And this is a special workshop. Most of the time we're trying to do them quarterly, but with everything kind of going on in the news, we'll talk about, the inverted yield curve today and, the Russia-Ukraine situation. We thought, let's do one more this month just because it is a little chaotic right now.
Yeah, it is chaotic. And also, too, we have a lot of things coming up at the office. Got some traveling we got to be doing here. We've got a new office where we're going to be opening, we believe. I think the date's going to be August 15th. So we got a lot of things going on. So probably won't do a workshop for a couple months here.
Yeah, and I want to be clear. We're not opening a new office somewhere else. We're moving. I don't want people to think we're going to open a branch out in Arizona or anything. No, we're just going to move down the street from where we're at.
I mean, you're right. We're moving down the street. Yeah. So, but anyways, let's talk about the important news from yesterday. Was the March jobs report. To no surprise, the job recoupment, I guess we'll say, continued in the month of March as non-farm payrolls grew by 431,000. Now, this did miss the estimate of 490,000, but the previous 2 months saw revisions total a gain of 95,000, which more than offset the current miss. The major area of strength continued to come from the hospitality as payrolls grew 112,000 a month. This comes as the industry still remains about 1.5 million jobs below February 2020 levels.
Yeah, and then, I mean, it's really unfortunate. When you look at the numbers here, after facing COVID, close to 90,000 restaurants had to close in 2021. Obviously, just couldn't keep up with the bills and the sales dynamic change. You had the openings, the closures. I mean, it was a very tough environment for those restaurant owners, so I do feel bad for them. Again, that number was 90,000 restaurants that did have to close in 2021, according to the National Restaurant Association. But looking at other areas of strength in the report, came from professional and business services, which were up 102,000. Retail, another area of strength that was really hammered during the COVID dynamic, that was up 49,000. And manufacturing jobs grew by 38,000. I did look at another major positive in the report as growth to the labor force participation rate. That now stands at 62.4%, and that comes after the labor force grew by 418,000 in the month of March. This level is just 174,000 people shy of the pre-pandemic level. So that was a big issue for many, many months. It was like, gosh, people just left the workforce, and we need people to fill all these jobs out there. And, that appears to be kind of coming to an end. And I do wonder if it's the high inflation rate. People thought maybe they could retire. Their 401ks were up. Their housing was up. They're like, yeah, I think I'm retiring. Oh, my gosh, this inflation, I can't handle it. I need to go back to work. So something did change to get people back into the labor force.
And I think it's so important. I use the word recoupment. is that we're just recouping the jobs that were there before. And I always hate when I hear people say, oh, jobs growth. It's not growth because these jobs were here 2 years ago. We're just replacing those jobs. We're coming back to those jobs from before. So it is a recoupment. I like that word. I think you put that word in there, didn't you?
I did, yeah.
Yeah. Tough word. I saw like, oh, recoupment. But I did want to talk about so many things to talk about in this. And I did see this past week. That's for some states. I think 3 states. I forget what they were.
I think it was West Virginia, maybe, or Idaho. And
Pennsylvania, maybe?
Maybe there's, I know there was 3.
Yeah. But what's nice is that they're saying, no, we're not going to pay unemployment for the rest of your life. They're cutting it back, I believe, to, I think it was like 16 weeks or 26 weeks or something, saying plenty of jobs out there. Go out and get one. And this is proof from the Job Openings and Labor Turnover Survey called the JOLTs report. The Job Openings Labor Turnover Survey continues to post elevated numbers. In the month of February, there were 11.27 million job openings, which compares to the total number of people counted as unemployed at 6.27 million. This now means that there's a record 5 million more openings than people than unemployed.
Yeah, and another way to look at it, this is a really crazy number to me, is when you look at the people that are unemployed compared to the job openings, that now means there are 1.8 jobs per person that is unemployed. So if you don't like one of the jobs, well, there's another one out there for you almost to go look for. The quits level also continued to remain above the 4 million mark and rose slightly from January to 4.35 million in the month of February. And with this report, I continue to believe wage inflation will remain elevated. And no, I don't think wage inflation is going to skyrocket to 8-9% or anything crazy, but I would not be surprised to see a continuation of wage inflation around 3 to 5%. I think last month it was somewhere in the 5% range, which again actually is still not keeping up with inflation at 7.9%. I'm curious to see what this month's CPI number will be as well. Well, I guess it would be for March CPI.
Right. Well, Chase, I have a solution to the situation. I mean, when I grew up, because you just did this, you had a full-time job and a part-time job. So if everybody were to take a full-time job and a part-time job, we kind of would help out here a little bit. And I don't know of anybody off the top of my head anymore that has 2 jobs. Do you?
Some people I know that will drive for like Uber or Lyft or something that, they do have their full-time job and they say, I'll kind of drive around just, I mean, I know you kind of, I don't know if it's jokingly, but you said, I don't know, I think it'd be kind of fun to drive you around. And
I think it would be fun, yeah. I can take out my Escalade and pick people up and talk to them. Yeah. Although, what if somebody doesn't talk to me? I kind of feel like hurt, like, what? You don't want to talk to me?
Yeah.
But yeah, I think it would be. And actually, I remember reading a long time ago, he was a congressman in a small town, and he actually drove Uber. And he says, I like to do it because I get to hear from the people what they think about what's going on. So,
it's interesting. I mean, I guess we'll see.
Yeah, you might show
when
up.
You get bored one day.
And I get out, open the door, like, come on in, I want to talk to you. Well, let's talk about the previous 401k accounts because with the level of quits we have seen in the JOLTs report, many are deeming this era of time as the Great Resignation or the Great Reshuffle as employees are changing companies at an elevated rate. One item to be aware of is if you change jobs, is your 401k at that old employer. As of last year, it's estimated that Americans had about, $1.35 trillion in old employer 401k plans. And that's not a good thing.
Yeah, and with quits remaining high, I would not be surprised if that level has continued to climb. And generally, we say it's best to roll that old 401k into an IRA rollover. And what it does is it simplifies your financial situation so you don't have to keep accumulating new accounts every time you change jobs. Unfortunately, we have seen clients that had several old 401ks and ultimately forgot about 1 or 2 of them from older employers. Other downsides actually do include administrative fees that come with 401ks and the fact that you're at the mercy of the old 401ks fund lineup and any decisions that the trustee decides to make to it.
Yeah, and that's the thing is that you don't know what's going on. They may, change funds and go. And we as a service for our clients, we actually look at their 401k plans and we say, we'll give you a recommendation. We can't do anything with it, but we'll give you a recommendation what you have. We have seen some horrendous looking plans that people have like, this is the best you can do, but you got crap for options, and you could have left your 401k there and maybe it's $100,000 and you know what's going on. and they went from a good plan to crappy plans and just automatically moved into these crappy plans. Or maybe they even moved into some balanced fund or some money market fund, or who knows.
Yeah, and I mean, the big thing is just forgetting about. You could forget. I mean, it's like $5,000. Let's say, oh, that's a lot of money.
Yeah.
You could just forget about $5,000. You don't want that to happen. The other thing I'll point out too, and I hear people, oh, well, my 401k funds are super low because I get institutional shares,
Right.
which as a retail investor you don't get access to all the time. In the 401k you would. But the thing that you have to know, and we do 401ks for clients, and we do have to use different pieces of the puzzle. It's not just an advisor that you're paying in a 401k. There's the advisor, there's the third-party administrator, there's a record keeper. All of those are fees that you have to pay for that you don't have to pay for in your IRA rollover, and they can add up quite quickly. And I've seen plans when we take over plans for our businesses that we do 401ks where you're paying close to 1% for an index fund because of all the other fees on top of the fund fees that go in there. So you have to be really careful. You could be way overpaying in that old 401k. And if it is your current 401k, I'm not discouraging you to contribute to that because that is still important. You may be overpaying for it, but you can't miss that match and you can't miss that deduction for the 401k. It is kind of part of the rules. And unfortunately, there's so many regulations that come with the 401ks. That's why all these other parties have to be involved, and that's why the fees are so high.
Yeah, and again, we've seen plans where people don't think they're paying those high fees, and they are when you kind of dig into it. And some companies done a great job of hiding those fees. So be careful, understand. I mean, that's one thing we do when we do 401k plans for businesses is we really lay everything out. We show them the fees like, oh, wait, we're paying you a management fee? Yes, you are, but you're getting management of the portfolio. But also, too, we disclose the fees so you know what's going on.
Well, that's so true because a lot of times when people look at they're like, oh no, I don't pay a record, I don't pay an advisor. What they do is they lump all the fees into the fund fee. Yep. So like we have the exact same fund, let's say, but we'll break out our advisory fee and the record keeper fee so you can see what you're paying. Where a lot of other firms, what they'll do is like, oh yeah, no, there's no other fees. It's just this fund fee, but it's twice as high sometimes as what the fund that we use is because they just wrap it all into one fee. So you got to be really careful. Those 401k fees they can be quite dangerous. I did want to say one other thing too on the previous 401ks is think about you have 5 different 401ks. Let's say you get married, you have a kid. Mm-hmm. Are you going to remember to change your beneficiaries on all 5 401ks? That's why it's so important, I think, to move it with that IRA rollover. Because and we always say it's like a suitcase. You take it with you from job to job because that way you only have to remember to change your beneficiaries on one account rather than 5 because that could be very dangerous. If you pass away, that money's going to the state.
Yeah, and I've been doing this for over 40 years. I've always recommend roll your 401k over, especially so you can keep track of it so you know what you're doing as part of your financial plan. And I know there's people that lose them. They forget about them. I haven't had recently, I think it's like 15 years ago, I had a client that actually passed away, and we could not get hold of anybody for the beneficiaries. She didn't have a beneficiary on the account. And, well, went to the state. So keep track of your stuff. Best way to do is keep your life simple. And, again, you mentioned married and a kid. Well, now you're going to have life insurance. You're going to have a house. You're going to have a new work 401k. You've got all these. It's just too much. Make your life simple. Keep your money. And I always say it's like a suitcase. Just keep putting that suitcase, more money in that suitcase if you change jobs a lot. So, all right. Phone number 833-288-0973. Again, I'll get you through for your unbiased, no strings attached, fundamental opinion about what you want to talk about. 833-288-0973. Let's go to Alpine and speak with Jim. Jim, you're on the Smart Investor with Brent Chase. How can we help you?
Hey, good morning, guys. How are you we got an early May gray here. I don't know what's going on with the weather,
Early April gray. Is that what you mean? April or May?
Hey, so I need a little narrative on AT&T. I bought it, some of the shares I bought 366 days ago, and some of them I bought I can get a tax loss harvest like next Friday, and I'm thinking of doing that. But I'm looking at all the mergers and stuff going on and going, what the heck is going on with this company? Is it worth future earnings look flat? Is it worth hanging on to it all, like doing a wash sale or anything like that?
Well, let's look at the numbers here, and then we'll talk about it because there's some good numbers here behind AT&T, which just don't seem to be coming to light. Companies AT&T, their symbol is T as in Tom. They're in the telecom services industry. A good sign that it's gonna do well is that the short is only 1%. So that means
that's good.
Yeah, they're not thinking it's going to go down. So institutional ownership on the low side, I'm surprised on this, 55%. The PE ratio very good, 8.7 versus 14.1. Price to sales 1 versus 1.4. Price to book value 1, below the industry at 1.8. And price to cash flow very good, 4.1 versus 4.8. Also, too, AT&T has a very good PEG ratio. And PEG ratio is your price earnings divided by growth. Tells you how much you're paying for the future growth. It's only 2.1 versus 6 for the industry. And by the way, the S&P 500 is at 15.2. We have said that the S&P, I think, is pretty pricey. That's one thing kind of proves it. As far as AT&T goes, they have no earnings change over the last year. Last 5 years, it is an increase of 6.2. That is about half the industry at 12.3. They have done a lot of things over the past 5 years. Over the 1 year on their sales, they're down 2.3%, but the industry was down 4.8. The 5-year estimated growth on earnings for AT&T is a 3.7 versus 9 for the industry. They do pay a dividend that is, well, this is kind of strange. This kind of change here for me. It shows 4.6%. And when we did our numbers last week, it was like, I think like 8. So I'm not sure why we're showing 4.6 versus 3.6 unless...
Yeah, they cut the dividend from $2.04 a year to $1.11 a year.
Well, that's supposed to happen with the spinoff.
This bakes in future.
So they're looking in the future is what they're doing here. Okay, I was unaware. Yeah, because I knew it's coming up, so now we're seeing the numbers. So that then is very attractive, 4.6, because that is going to be the dividend you're getting going forward. That is above the industry at 3.6. The payout ratio only 75%. I like seeing that. We do see that they have on the balance sheet a current ratio of 0.7 versus 0.9. Debt to equity looking good, 1.2 versus 1.7. We do see a net profit margin. Well, that checks in at 11.9, above the industry at 10.4. Return on equity 12 versus 14.4. And Chase, you seem to be ahead of this here. So did they already do the numbers for the spinout? It's going to happen this week, you think, or what's going on?
I'm going to do the numbers, and then I'm going to talk about the whole story
Okay.
after. I think it's just too complicated to try and do both. So let's look at the current price here first for AT&T. It's $23.98. 52-week high, $33.88. And the 52-week low, $22.02. Year-to-date return, it's about flat, down 0.5% for the business. If I go out to December 2023, I do see estimated earnings per share of $3.24. Would give us a target sell price of $53.78. Now, I'm going to say that estimate is somewhat misleading because we know that they are going to be splitting in some fashion next week. And it's a very complicated process. They're not officially splitting next week. You're like getting your stock shares in this company that is going to be happening down the road in a few weeks. So like next week, I think it's on April 5th is when they'll kind of issue these shares.
So it is happening April 5th. Okay, I know it's coming up. I thought
but it's a very complicated manner because you won't have Time Warner Discovery shares. You're going to have, I forget what they're calling it. It's like AT&T Time Warner Discovery. You're going to have this subset of shares that will be converted to Time Warner Discovery shares down the line.
Sounds like you've done some reading on this.
I have done a little bit of reading on this, yes.
Because I'm not seeing anything on it. I knew it was coming up, but I didn't, and I thought it was coming up this week. Mm-hmm. So they're starting to come up with some confusing things here. So this is going to confuse the reporting companies that we use, going to really confuse the investors. And I think what you have to do is just kind of be patient, kind of wait through here.
Well, I think that's the whole thing is that stock is flat year to date. And it doesn't surprise me. We've been saying this now since I've kind of issued it, that the stock has been, trading up and down. People sold it on the dividend cut. But the dividend cut's really not as bad as people make it out to be because you're getting now shares in Time Warner Discovery essentially for, I don't want to say free, but that new dividend of $1.11 is not incorporating that Time Warner Discovery deal. So in theory, what you can do is if Time Warner Discovery is a terrible company to hold, you sell those shares, you buy back for free essentially your AT&T shares, and you drive that dividend from a 4.6% yield to over 5%. Right. So it's not a full cut in half on that dividend yield. lot of kind of thought process here that goes into it, Jim. My whole thinking on this stock is be patient with it, kind of let it work its way out. I don't think I would do any buying and selling on AT&T at this time. There's just a lot that's going to be happening over the next few weeks, and I do worry about that Time Warner Discovery. I don't think. I think you probably know now we own it in the portfolio, so I'm just gonna I'm gonna put it out there. Is I don't think we're gonna sell the Time Warner Discovery shares right away, because I think there's gonna be retail investors that want to get out of it quickly, and it could go too far down too fast. I think we're just going to be patient. We're going to wait for new numbers to come out. That way we have good numbers to make good decisions with on both new stocks.
Yeah, and I would not be thinking of doing any tax harvesting here, because you could really do it at the wrong time. I think waiting until maybe 1st of May, I mean, we got to see how this shakes out here, because I think AT&T has some good assets. I mean, they are the second largest, I think, behind Verizon as far as cell phone goes. They got the fiber, and now they can kind of focus on this. I mean, I think they're cleaning up their balance sheet. That's what I'm saying. I think AT&T is good for them. Also, too, the new company, I think that could be very good. So I'm going to be patient with this here. I mean, that's what we're doing. I would not get too upset about, I'm going to do some tax loss harvesting. No, I think I'd wait, see what happens here.
There's just too many moving parts where you're kind of blind trying to make a decision. I want the numbers before I'm going to make any decisions on these companies.
And I'll never forget, too, that when this was first announced, John Malone, who's done very, very well in the industry, he said, this is such a fabulous deal. Yeah. So he really liked it. So he knows the industry's been doing it probably 50 years, I'm going to say. So, so Jim, don't do anything. Just kind of watch. Sit on the sidelines and watch. How's that?
I know. I was confusing the daylights out of me. You're trying to catch up on. I figured I'd get a narrative from you guys, which I got. So thanks for that.
You're welcome.
And problem is, I got a serious capital gain happening later this year, and I was looking for some ways to offset it.
And you might be able to in May. I mean, that's what if you do have it, you could maybe look at doing some tax loss harvesting after this is all settled, because I don't think that the stock's going to pop by any means. So be patient with it. I think you wait until, as you said, around May, and then maybe look at doing some tax loss harvesting if it makes sense.
Yeah, that's the key.
Yeah, after everything settles out. Yeah.
And don't be too excited about people. I want to do tax loss harvesting. Sometimes you can miss bigger gains because you're so excited about trying to get off that, not pay taxes. And we always tell people, we'll never make a tax decision over economic decision. And sometimes you make a decision to sell something this year to offset the gain, but next year the thing you sold went up 30%. So it wiped out the benefit of taxes. So I always tell people, don't get too excited about the tax side. You've got a capital gain. That's good. You're making money. You can make big money on this company that was not so good this year. Next year, that could be the big winner. Yeah. So be careful. So, all righty?
I appreciate it. That's why I called, to give him, get the narrative on this thing. Thank you, gentlemen.
All right, Jim.
And see you. Probably see you at La Jolla Concourse.
Yes, we'll be there.
Oh yeah, it's coming up.
That's right. Coming up in April. Have a good one, Jim. Bye bye.
We'll be in the Ferrari row Friday night.
I'll be in the Lamborghini.
All right.
Have a good one.
Wrong row, pal. Wrong row. See ya.
Bye bye. All right. That does open the phone line 833-288-0973. That's 833-288-0973.
Before we go back to the calls, I did want to. I teased with the yield curve inversion, and we never talked about.
I didn't hear you tease on that. Did you tease on that? I
teased on that because I asked before the show. I was like, "Are we going to talk about this?" He said, "Yeah." So I'm like, "Oh yeah, we have a lot of chaos, like the yield curve inversion," and then I think it's something important that we got to talk about.
It is important. I don't know how I just skipped over it. I'm sorry. So okay. So people are worried about the yield curve inversion, and this is important. This is when shorter term bonds offer higher yields compared to longer term bonds. While this has been a reliable indicator of recession in the past, it is by no means something to panic over. Since 1977, the 2-year and the 10-year yield curve has inverted 7 times.
This was there was one case actually in 1998 when a recession did not follow, but on average, it still takes about 17 months after the inversion for a downturn to start. So yes, it's a reliable indicator, but you kind of stretch it out sometimes. 2 years is when the recession. It's kind of a funny thing. It's almost like, you always talk about correlation
Right.
is, I know David Dreaman talked about, well, every time a red car drives by, the hand goes out the window or something. It's just kind of something that happens when you see a red car. It doesn't necessarily mean that's the root cause. I think that people try and fit this peg into the fact that, a recession comes every time it happens. I mean, it's 2 years after. I think a recession just kind of comes naturally after those time periods. But the thing that I do say is that 17-month time frame, I mean, that would still fit into our expectation that we're looking at a small recession later in 2023. So it does kind of fit the narrative that we are looking for this time. But I'm still going to say, even with a recession, I still believe the right stocks will do just fine. And in fact, a year after inversion, the S&P 500 has been, on average, 11.8% higher. The only time since 1977 it was lower occurred after the February 2000 inversion. If you hold the right companies here, don't panic over this. I do worry about the S&P 500 over the next year, but I just wanted to pull that out because people, oh my gosh, a recession's going to happen. I got to sell and get out. And no, as I said, it's up on average 12%, close to 12% 1 year later, and I think the right stocks are going to do just fine over the next year.
And you can't just look at one indicator. Yeah, okay, so it's inverting. But you've got to compare, like in past recessions that happened, well, how much cash was in the economy? Again, we've talked, there's like $21 trillion in the economy. Maybe the last recession there wasn't, so people don't have extra money to spend. Perhaps in the last recession there wasn't 1.8 jobs for every person. I mean, there's so many things now that are different than before. You can't just look at one thing and saying, it's inverted, gonna have recession. And again, you talk about 17 months out. A lot can change in 17 months as well. And we have said on the show that I think in 2023, we're going to have a slowdown, perhaps a small recession, but nothing to panic or should panic anybody to sell everything and go to cash. Cash is not a great investment at all, especially in this time. You're going to be way behind inflation.
Yeah, and the other thing we talk about too is on that inversion, you have to understand what the Fed is doing here. The Fed is hiking right now, or they did hike short-term interest rates. Well, when they announce those Fed funds rate hikes, that impacts the short end of the curve, or likely the 2-year. But they also have a bond purchase program right now where they've been buying back bonds. Now that has been unwinding, but they haven't allowed the balance sheet runoff to occur just yet. The reason that's important, that affects the long-term yields rather than the short-term yields. So they've kind of started with the short-term yields, and then I think later this year you could see, that's why I wouldn't be surprised to see the 10-year note above 3% by the end of the year, is because they're going to start allowing that runoff to happen, I believe, which is going to impact the long-term side of the curve. So I think you have to see what the Fed has done. That's kind of, I'm going to say, manipulated the inversion somewhat as well. And
that's another thing in the past recessions, these past inverted yield curve, you did not have. You did not have the Fed holding, what they hold, like $9 trillion? They didn't have that back then. No. Then I think they had like $1 trillion. They couldn't do anything with the long end. Well, now they've got about $9 trillion, I believe. They can stop buying that. They could maybe even do other things, So they've got a different situation here. You've got a different economy. You've got a different job market. So I believe we'll have a slowdown because it's going to be a natural, situation, but it's not going to be anything to panic over and like, I got to sell everything and get out because we're going to have a major recession like 2008. No, not going to happen.
And the other interesting time period is the last inversion was actually 2019. Mm-hmm. I'm very curious, if we didn't have COVID, would we have had a recession?
Oh, yeah.
Yeah. Just be careful, I guess, saying because this happened, this always happens. And what if you go to cash and all of a sudden we still have inflation of 6% and we don't have a recession and stocks don't crash, and now you've just lost 6% per year on your money because you've been in 100% cash. So just be very careful. That's why it comes down to, I don't want to say not focusing on the macro side of things, but focus more on your businesses and how they're handling the different types of environments. I think the micro or the looking at the companies is so much more valuable than trying to time the market and what's going on with the whole economy.
Right, and not worry about where you're going to be next month or 6 months down the road, but where you're going to be 2, 3, 4, 5 years down the road by doing the right thing today. So phone number is 833-288-0973. That's 833-288-0973. Let's go up to San Marcos and speak with Phil. Phil, you're on the Smart Invest Show. Brent Chase, how can we help you?
Hey, good morning, guys. How you guys doing?
Good. How you doing?
Hey, good. Hey, I wanted to comment on, we were skiing with the family last weekend, and I was able to catch the show on the podcast on the drive home.
Cool.
Awesome. So great to hear last week's show. But for today, I've been seeing the semis get hammered a little in the back half of the week, and got a little small piece of on semiconductors, ON, and as they've come down a bit, I'm thinking of getting more, but wanted to get your guys' opinion first.
Yeah, I've never heard of this semiconductor company, so I'm kind of excited to look at a new company. You said you hold this, correct, Phil? You hold this, Phil?
Yeah.
Okay.
I'm sorry. I hold maybe about 1.5% of my portfolio.
Okay. Well, let's take a look at on semiconductors. Their symbol is ON. Only 3.5% short is what they have there. 97.7% institutional owned. PE ratio 26.3. That is above the industry at 25.4. Price to sales 3.9, below the industry at 5.9. Price to book value 12. That's very good because the industry is over 100. And then price to cash flow 14.9 versus 16.2, and a nice PEG ratio of 0.8 versus 5.3. Now, earnings for the past year are up 187%, well above the industry at 44.3. We do see sales climb by 23.5%, also well above the industry at 3.2. Nice 5-year growth rate here on the earnings, 18.8, about the same as the industry at 19. We see they do not pay a dividend. Their balance sheet, current ratio 2.5 versus 3.5. Debt to equity about the same, 0.7 versus 0.6. Net profit margin checks in at 15. That is under the industry at 23.9. And return on equity is very respectable at 22, but not quite as good as the industry at 28. Chase, what do you got?
Yeah, so current price here for on semiconductor is $59.63. 52-week high, $71.25, and the low, $34.01. Year-to-date return, as you kind of said there, Phil, it struggled a little bit, down 12.2%, and I'm pretty surprised. This is not a small company by any means. Market cap here, $26 billion.
Wow.
Close to it. I was curious what they do, and it looks like what they provide is kind of sensors, power, and analog semiconductors. And I'm not a tech guy, so I'm not quite sure who they're going to be supplying directly. Like, do they work with, the Intels, AMDs? Do they kind of provide some pieces for them? Or do they go directly to, like it says here, they're big into the autonomous driving. Do they go directly to the auto companies? So I'd be curious more on how their supply chain functions. And in fact, this is interesting. They are the largest supplier of image sensors to the automotive market.
Oh, wow.
And we know the automotive market has been struggling with chips lately.
Yeah.
So that could be good for their demand going forward. And they did say they are focusing more on the automotive, industrial, and communication markets and reducing their exposure to consumer and computing markets. I like that they're in different spaces. Now, if I go forward for this company, again, ticker symbol here, ON for on semiconductor. I go out to December 2023. I see estimated earnings per share of $4.41. That gives it a target sell price of $73.21. So a nice forward PE here of about 13.5. I might watch it a little bit more. I know you said you hold some, but looking at maybe adding to it, I think I'd be a little bit more patient, just kind of see what happens, do a little bit more research on it, try and get a little bit better deal, because 13.5 is not quite where we like to normally buy, under 13 times earnings, I would say. So it would be in our hold category. But I think this is an interesting company, and could be worth the further research.
How far away is it from the target sell price? Is it like 25%?
I know you're going to do that to me.
Well, I saw your calculator over there. I thought you had that.
23%.
Yeah, 20. Yeah, so you got to be a little patient here. What could happen is the earnings could go up to increase the target sell price. Perhaps the stock falls a little bit more. They're low for the year is 34. So, gosh, I think if you got down about 55, it could be a buy in this company.
Yeah, and the other interesting thing here, too, is I look at this year, 2022, earnings are estimated to grow 41%. So where is that huge influx of earnings growth coming from? And then next year it's 5.9%, which I'm okay with. That's fine growth on this business, especially if you get it for 13 times earnings. But how in the heck are you going at 41% this year and then just close to 6% next year? What happened? Did the automotive slowdown really impact them? There's some questions that I'd want to answer here, Phil.
Yeah, Phil, I think it's a company worth watching because they got a good product. It's not way overpriced like some chip companies. So, worth watching and stay with what you got and just keep watching and see if they add to it. All righty?
Yeah, so the research should be really on the supply chain and future revenue streams.
Yeah, like who?
Because I'm going to start looking that stuff up now.
Yeah, who are their customers? I mean, who do they work with other chip makers, or do they work with the automotive companies directly? I'd want to know, too, the breakdown of the industry. So I said they're focusing more on automotive. Is that right now only 5% of their business? I'd want to know the breakdown of the segments because, the consumer and the computing side, there's been talks of maybe that's slowing down a little bit. It's good they may be pivoting to other industries. But, if the consumer's 60% and that slows down, that's going to hurt the company. So I'd want to know the breakdown of the revenue.
Yeah. All right, Phil?
All right, guys. Thank you very much. Have a good weekend.
You too. Bye-bye. All right, that does open the phone line, 833-288-0973. That's 833-288-0973. And Chase, I want to talk about the workshop again because it is coming up this Thursday at 6 o'clock. It's going to be in Scripps Ranch, and at that workshop, we talk about what is true financial planning. We talk about what is the individualized concentrated value portfolio. We kind of show you how we buy the right dividend stocks. We also talk about 19 thoughts, and this is always very popular for people because they all do it. 19 thoughts that lead to your underperformance, and how many positions should you hold in your portfolio? These are all things that we go over for you to make you a smarter investor. But what you have to do is you have to sign up. It's a free workshop. Go to our website, smartinvesting2000.com. That's smartinvesting2000.com. Or you can call the office, 858-546-4306. That's 858-546-4306. Talk to Priscilla. She gets us signed up. And I think we still had a few seats left, I believe, is what we had left.
Yeah, I believe so.
Yep. So, all right. So, hope you see you on Thursday, this coming Thursday. Right now, time to talk about financial planning. For that, we turn to our financial planner, Harrison Johnson. Good morning, Harrison. How are you doing this morning?
Good morning, guys. I'm doing well.
Well, good. I like this topic because every once in a while this comes up, and it is life insurance is a retirement solution, question mark. I mean, every once in a while this comes up like, oh, I'm going to buy life insurance for retirement. Why don't you explain what's going on here, Harrison?
So to explain, I've got a little story to kind of help illustrate. So I've got a family friend. They've been funding a SEP IRA because they're self-employed. So they've been doing that for a lot of their career. And they encounter a salesperson who approaches them, not us, obviously. A salesperson comes to them and pitches them, well, do you think taxes are going up? And they say, oh, well, sure, I think taxes are going to go up for various reasons, whatever. And so then the salesperson responds, well, you don't want to be funding that SEP because all those withdrawals are going to be taxable, and that's going to be really bad for you in retirement. So the solution then from this salesperson is then to buy life insurance instead, because with life insurance as a retirement plan, you basically have to put a ton of premiums in there, build a lot of commissions for the person selling it, and then the hope is that you build enough cash value inside of this policy so that you can borrow from it, and then since you're borrowing, that's going to be tax-free. So that's going to be much better for your retirement. You're not going to have to worry about taxes. So that's kind of the premise of this is a real story, by the way. This is actually happening with somebody I know. So if we dissect this, number one, taxes are going up. That I think is probably true. At some point, I think we could see some tax increases, whether it's in 2026 or before with the administration, what they decide to do. But that doesn't necessarily mean your retirement taxes are going to go up relative to what the current taxes that you're paying. For example, with my friend here, right now they're in the fourth tax bracket, which is 24%. Well, that's because they're working. When they go into retirement, their income is going to be Social Security, which is partially tax-free, rental income, which is partially tax-free because of depreciation expenses and that kind of thing. And then they have this SEP. Well, right now their RMD is expected to be about $20,000 from that SEP, which isn't going to be a huge tax problem. They're going to be able to stay in like the 12% bracket, which means if they forego funding the SEP right now, they're missing out on a 24% deduction just so they can save 12% later on. It doesn't make any sense. So that's the first thing. Second thing, if retirement taxes for this person was a problem because they have lots of ordinary income sources and a lot more pre-tax money or whatever it is, well, all we would need to do then is fund the SEP, get the tax deduction, and then we could convert that over to a Roth, because then the conversion is taxable, but it's offset by the contribution to the SEP. So that way we could just fund a larger Roth contribution, which all that would be tax-free in retirement. So that's the second thing. The third thing is these friends of mine are in their 60s, which means when you have life insurance, every year you get older, the cost of insurance is much higher. So it's going to be extremely difficult for them to build enough cash value so that they can actually retire and then borrow from it. Because if they don't build enough cash value, that policy is either going to not be able to give them income, or it's going to lapse on itself, which is going to be fully taxable, and they'll have no cash to pay that tax. So that's the real retirement tax problem, which would be with this life insurance thing. So, you have to watch out for salespeople and pitches and, oh, yeah, taxes, I don't like taxes. Well, make sure there's a connection between the solution and the problem that they're explaining.
And Harrison, you said it's a real story. And what shocked me was you said they're in their 60s. I thought you were going to say they're in their 30s because that's usually like, long time. But these salespeople, that's what you're taught in sales. Focus on people's emotions. Everybody hates to pay taxes, so that's what you focus on. I mean, as opposed to the things you bring up, like the time value of money. I mean, all these expenses they take away from your returns. And again, they're in their 60s, but still now if they're in their 60s, they could easily live another 20, 30 years. I mean, it's just, I get kind of, and life insurance is a good thing to have for the right people. But to be sold as a retirement plan, in my 40 years, it's never, ever made sense to me, and I don't know why people do it. If people have a life insurance person trying to sell them life insurance or retirement plan, close the door and walk out because it's just not right.
And I will say, too, Harrison, we were talking. Go ahead, Harrison.
Yeah, I was going to say another analogy for it is, everyone hates reverse mortgages. You say, oh, we should get a reverse mortgage. Oh, everyone hates that. And in some cases it can be useful, but that's a separate point. But life insurance as a retirement plan is basically the same exact thing as a reverse mortgage. With a reverse mortgage, you have some equity in your house, and you're just accessing that equity to fund things. And since you're accessing it through a loan, it's all tax-free. That's exactly what life insurance is. You have cash value, and you're accessing that cash value through a loan that you're getting from an insurance company, and you're just hoping that the loan balance never gets to that cash value. And actually, reverse mortgages can be even better than life insurance because generally home values go up over time, where as you get older with life insurance, the cost of insurance continues to go up, so that eats away at the cash value. And if you ever do go underwater in a reverse mortgage, at least you're not forced to move out, where with life insurance, it lapses on itself. So, people have no problem balking at reverse mortgages, but really life insurance is even worse than that.
And I was going to say, too, I mean, when you talked about this family that was sold a life insurance, all you have to do to sell life insurance is get your life and health certificate or whatever it's called. And this guy was talking about tax. He knows nothing about taxes.
Right.
His education is nothing. It's just a hot button that he was told to sell on. But I bet you they don't even know the tax brackets, how they function. And, as you talked about the deduction versus their retirement, they didn't look at any type of analysis like that. And that's what's just so irritating to me is that people are sold on their emotional side of things by people that don't even understand the products and how it's truly impacting them. And that's really where your value comes in, is you don't sell anything. You just are there to look at, if you do this, this is what's going to happen. And you break that down for them so that they can make the right decisions.
Right. Well, Harrison.
And I really understand taxes. Don't get me wrong. I hate taxes, and I really focus on that. So there is much more efficient ways that we can reduce retirement tax liability than buying life insurance.
Yep. Well, that's why you're a financial planner as opposed to a life insurance salesperson. So, Harrison, thank you very much. We'll see you Monday morning.
All right. Thanks, guys. We'll see you Monday.
Okay. Have a good one. Bye-bye. Again, it's Harrison Johnson. He is our financial planner. He's a CFP. If you want to talk to him or have a free consultation with him, call the office, 858-546-4306. That's 858-546-4306. Or you can go to the website as well, smartinvesting2000.com, smartinvesting2000.com. You can send him a message there. Chase, you brought up about the licensing and so forth, and I've got many securities licenses, and I to become an RIA, I took that was a test that was one of the hardest. I remember when I first was in the industry, I took my life insurance test. I went to the school called Mike Russ Schools, and they said, just do this, and you'll be fine. I passed that test in 13 minutes. It's like, what did I learn? So not to knock life insurance people, because, again, there is a right time for life insurance. But as you pointed out, they know nothing or very little about taxes or future values or investing. And it's a commission thing. And some of those commissions can be 60, 70, 80% commission off of what you're putting in. How can the person make any money with that type of commission?
And especially if you're funding that as a retirement plan, you're talking about trying to oh my gosh, they're probably like, yes, I'm making so much money off of this.
And the problem at our office, and the same thing with Harrison, we are, investment advisors, financial planners. We're not salespeople. If we go up against a good salesperson, we're going to win, because they are so good. They can sell many people. We're going
to win or we're going to lose?
No, we're going to lose.
Yeah,
a good salesperson.
You said we're going to win.
No, well, I meant they're going to win.
They're going to win.
They're going to win, because we can show them all the facts and so forth, but that salesperson knows their hot buttons. They know how to sell them. So let's go back to the calls here. 833-288-0973. That's 833-288-0973. Let's go to Oceanside and speak with Joe. Joe, you're in the Smart Invest Show. Brent Chase, how can we help you?
Brent Chase, that Harrison boy, he's growing on me.
That's good to hear.
Yeah, I didn't care too much for him when he first joined you guys, But over the time, he's growing on me. I would definitely talk to him.
Well, good.
Well, good.
That's what we like to hear. What can you do for
But
you?
hey, you know what? QCOM has been really getting hit here, and I was wondering if you could shed some light on why.
I don't know if I can shed some light, but I have seen it. I'm kind of smiling a little bit to see that, because maybe it's time to look at buying some. So let's say the numbers on Qualcomm, because I've not done that lately. So symbol for Qualcomm is QCOM, only 1.5% short, 75% institutional owned. PE ratio now 16.8 versus 25.4. Like seeing that number. Price of sales 4.7 versus 5.9. Price to book value 61.5, but the industry is over 100. Price to cash flow is 17.9. That's the only valuation ratio over the industry, and that's 16.2. PEG ratio is now 0.9 versus 5.3. Now, Qualcomm, over the last year, they've increased their earnings by 25%. Not quite as good as the industry, up 44. Sales for Qualcomm are up 22.5% versus the industry growth of 3.2. The 5-year earnings per share growth for Qualcomm, 14.7. That is under the industry at 19%. They do pay a dividend, not a bad one, about 1.9%. Use 30.4% of their earnings to pay that out. They have grown that dividend over the last 5 years at a rate of 5.1%. They've grown it for 10 years in a row. We do see on the balance sheet, got a current ratio of 1.7 versus 3.5. Debt to equity is kind of high. I think they've taken on some debt. They didn't used to have this debt before. 140% versus 60% for the industry. And we do see a net profit margin of 27.7 versus 23.9. And then return on equity, 88.1 versus 28. I'm thinking perhaps Qualcomm has a low amount of equity, but we can.
And I'm going to assume that, because I know they did huge stock buybacks over the last few years, which again reduces their equity on the balance sheet. So it kind of explains their debt to equity and so forth. And I know it's a business that kind of hold near and dear here, because they are a San Diego company. So with that said, though, let's look at the current price for Qualcomm, $146.99. 52-week high, well, that's $193.58. And that did occur on January 5th of this year, so nice little pullback from the start of the year. 52-week low, though, $122.17. As I did say, it struggled so far in 2022, down about 19.3% to start the year. Let's now look going forward for Qualcomm. I go to September 2023. I do see estimated earnings per share of $12.58. Would give us a target sell price of $208.83. Very attractive forward PE of under 12 times. I mean, I like to see that. I think Qualcomm's a good business. I do remember years ago when we did hold it, though, one thing that always concerned me is their legal bills are just so high, because they make so much money off of licensing technology rather than actually doing the technology in some cases. So they're always having to defend their patents, which is quite costly. And that's just one thing I point out that was always in the back of my mind when holding Qualcomm. But the numbers do look good on the valuation side.
Yeah, definitely worth. And I have seen, been going down. And I thought, yeah, maybe we should take a look at Qualcomm because I like it. We don't know what's going on other than that because we've not been reading anything on it and so forth. I've seen nothing in the news on Qualcomm, but I think it's definitely worth looking deeper into because of that fact. And I did look at the balance sheet. Their equity is now, where'd it go? Come on.
And while you're doing that, I was going to say, too, the other thing that concerned me with Qualcomm is China was always kind of where a lot of the semiconductor manufacturing occurs. I always do worry that China's like, no, we're not going to honor that patent any longer.
And they can do that. What are we going to do?
Yeah.
That's what we're going to do. Their equity is now $11.3 billion. It did reach a high back in 2014 of $38.8 billion. So I think you're right. They've been buying a lot of stock back, which will reduce their cash. So that could be the situation. Their cash now is $11.3 billion. It was about $16 billion back in 2015, 2014. So they've been buying stock back, which is good. So, I mean, I like it, Joe. I think it's worth looking at, but as Chase brought up with China, and I've just not seen anything on the news of why it's falling. So you want to find out why it is falling because if it's what I call a fixable problem that's going to be fixed in the next 18, 24 months, yeah, we'd want to buy this company. But if it's something else that maybe there's having some other problems, I might stay away from it. So can't give you an answer, just give you some direction.
Yeah, I'm not sure if the whole thing, there's something going on with this other company, VEONEER, that I don't know if they're finalizing or what. I'm not sure if I think it might have been an all-cash deal or something like that. So,
yeah. And
maybe that had something to do with it because it really kind of fell hard Friday.
Yeah, the whole semiconductor. I know we took a look at On Semiconductor earlier. It looked like Intel and AMD and I think even NVIDIA as well. I think they all kind of the chip space really did kind of hit a speed bump on Friday.
And that can many times be a buying opportunity because if all the chip stocks go down and you got a strong company like Qualcomm doing fine, like wow, what a great time to buy more because they don't have the problems that they're saying these other companies have. So it could be a good opportunity.
Yeah.
Yeah.
And I think Qualcomm fell farther than the other chip companies. And, I picked some up on Friday, but I got rid of it on Friday too because, it was going down so hard. I said, oh, my gosh, I was down quite a bit. But, yeah, luckily I ended up making a decent amount. So
that was a trade, not an investment.
That's
there,
right.
Huh, Joe?
Yeah, using those emotions there, Joe.
Well, yeah, but, hey, never lose taking a profit, right, guys?
Oh, I hate sayings like that, Joe. I gotta tell you. They make you feel good, but they don't make you money many times. So.
Hard to argue, though.
Well.
Okay. Hey, well, thanks a lot, guys. I really appreciate it. I was wondering, what was happening with that thing because I just haven't seen it fall like this in a while.
Yeah. Keep watching it because I think there could be opportunities, but I've not seen anything in the news about it, so I do some research. Maybe we'll look at it maybe next week. I don't know. So, Joe, thanks for calling.
Keep us posted.
We will do that. Okay. Bye-bye. All right. That does open the phone line, 833-288-0973. That's 833-288-0973. And see, now that Joe's gone, I can say like that thing of saying, what is it? Never
go broke, taking a profit.
Right. But you can sure cut your long-term returns that way.
Yeah.
And there's so many things like, what is it? Don't be sore, buy more. I mean, there's so many of those sayings out there that I think Wall Street created just to make people feel better.
I mean, there's just so many. Sell in May, go away.
Yeah,
I mean, there's just always these rules of thumb or sayings, as you said, that are catchy, but I mean, you got to be careful following kind of them as advice. I guess is what I would say.
And we just look at the company. It's like great company. Let's buy it. But we're not traders. So phone numbers again 833-288-0973. Oh, let me talk about the workshop because it is this Thursday. The workshop is going to be in Scripps Ranch. And we're going to talk about things that to try to help make you a smarter investor. And we do have some volatile times now. We're going to show you how the fundamentals pay off during these volatile times. How to stay away from that high-risk investing. That's what you're kind of looking at, like, I want to make money quick. Well, we're going to talk about how to stay away from those things that kind of suck you in, how to buy the right dividend stocks, 19 thoughts that can lead to your underperformance. And the big question we kind of show people, and this shocks people when we show them, but how many positions should you have in the portfolio. We'll show you why, not just how many you should have. It's not a guess. We'll show you why you should have that and something to kind of hold on to. It is a free workshop, but you have to sign up. Go to our website, smartinvesting2000.com. That's smartinvesting2000.com. Also, you can call the office, 858-546-4306. That's 858-546-4306. And Priscilla, she'll get you signed up there. Chase, we got this on Facebook. I put it down as a list here. I did not write down their names. So it says, if time on your upcoming Saturday morning show, please analyze CRWS and DOLE. We'd really appreciate it. We own both and looking to add more to get those holdings up to 3 to 4% of our portfolio, currently about 1 to 2%. Thank you. So I thought we'd take a look at CRWS here.
I think DOLE is like the pineapple company.
Well, I guess we can decide here. Which one do you want to do? You want?
Let me see real quick. This other company is called
Cruise, I think.
Crown Crafts. Infant and toddler products segment.
Let's do that one.
Let's do that one. We looked at Dole. Gosh, it's actually been a long time, but I don't think I've ever looked at this company. So
it's kind of nice to look at a new company that we haven't seen before. So let's say it's Crown Crafts, symbol is CRWS. They are in the industry of furnishings and fixtures and appliances. Only 0.1% float, only 41% institutional owned. We do see a nice PE ratio here of 8.4 versus 14.6. Price of sales 0.8, same as the industry. Price to book value 1.9 versus 32.5. And then price to cash flow 13.3. That is above the industry, unfortunately, at 9.6. Nice PEG ratio 1.7 versus 16. Now, the earnings have grown by 28.3% over the past year, about the same as the industry at 28.8%. We do see sales are up 5.5%, industry up 4.1%. The 5-year earnings growth on those earnings from the analyst is a 5% versus 4.4% for the industry. Ooh, they pay a nice dividend here, 4.9%. And use only 41.6% of their earnings. I like seeing that. I'm hoping to find a good balance sheet here. We got a current ratio 2.8 versus 1.5. That is good. Debt to equity only 0.1 versus 1.5. Net profit margin 9.3 versus 6.1. And return on equity is 17.6, just under the industry at 18.5. I'm getting kind of excited about this company. Are you going to destroy that on me, Chase? Or what do you got there going forward?
Unfortunately. Current price here for Crown Crafts, $6.50, 52-week high, $8.25, 52-week low, $6.07. It's down about 10% so far to start the year. Unfortunately, company size here, just $65 million. Tiny company, and with that, there's no analysts. So this is something you're truly on your own with, and there's no way to really for us to derive a target sell price. You'd have to kind of be an analyst and actually come up with your own estimates going forward on earnings. So that is something that is quite difficult with this business. The other thing I was going to say too is interesting. We talked about this big baby boom that was supposed to happen during COVID.
Yeah,
and I think people are saying it didn't happen.
Oh, really?
I that's just kind of what I heard. So I don't know any details behind it, but that would have been a big benefactor for this business. I'm curious if there are other numbers on the number of babies that were had now.
Yeah, you thought there kind of would be. You thought that would happen, but that would be great for this company. That's what I was kind of thinking as well. How's the baby boom doing, if one? But you're saying doesn't appear to be happening.
Yeah, I kind of heard just tidbits on it. I haven't done the full research on it because we don't have any baby product stuff in the portfolio.
Well,
so
you're getting married. You got to start pretty soon.
We'll see.
All right. There's the closing bell. Thank you for listening to the Smart Investing Show. It is for informational purposes only and should not be used as investment advice. If you'd like to discuss in more detail your investment needs, have other investment questions, feel free to call myself, Brent Wilsey, or Chase Wilsey at 858-546-4306. That's 858-546-4306, or visit our website, smartinvesting2000.com. That's smartinvesting2000.com. And for more daily educational information on investment tips, go to our Facebook page, Smart Investing with Brent Chase Wilsey. Have a great day. We'll talk more next week right here on the Smart Investing Show.